everyone, I hope you are all doing well. Just a quick video in order to share with you some basics about the Bitcoin options. As you know, Bitcoin is the most volatile asset that exists currently and one of the most traded due to the potential of this market. So also, Bitcoin is one of the most expensive assets that we can trade. So, Bitcoin options will, in fact, provide an alternative in order to take benefit from the potential volatility of this market, and at the same time trade it at an affordable price. So, options are derivatives. We have calls and puts. So, we know that when we trade an upside or a bullish trend that we think that the assets will go up, we buy a call, and when we think that the asset will or the underlying here will go down or drop, we will trade the put. And all this, when we buy options, we pay a premium. The premium will be a fraction or a portion of the underlying price. So here I will be using Deribit in order to show you how it works. Well, the basics will be the same on all the platforms. So here I will go to options. Well, futures are another thing. Well, options, and here we'll have the expiry dates and let's say the calls and the puts. For example, if I go for 39 days expiry date, so here we will have the calls on the left, the put on the right, the same thing everywhere. And here the basic that I want you to understand is about the premium. In fact, it's calculated differently. The premium will be in fact a percentage from the Bitcoin futures. What are futures? Futures are in fact derivatives as well. In the family of the derivatives, we have options and we have futures. So the futures, let's say, in fact, they will give you the obligation to buy or sell the underlying at a certain price. So here, what we need to understand that the price of the option, the premium, will be calculated by multiplying a percentage by the value of the futures. So the futures on May will be 40,467 here, and the price will be calculated through this 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 number if we want to buy at the ask, or this number if we want to buy or we want to sell the call. So here just below you have the calculation already done, so you know that you will pay 2,488 for the ask in order to get the 42,000 strike call. It means that you believe that the Bitcoin will go above $42,000, and the more it goes up, it will make profit. And here we apply the same techniques with stocks options. It means that we start making profits with the delta. We'll have the delta here, 46, and it will be theta negative if we buy options. So we will be able to apply the same strategies that we can do on stocks options. For example, volatility strategies, especially the calendars and the diagonals. You will see that it can be very interesting in order to get some strategies for an affordable price. Of course, here, for example, let's say I want to trade a calendar. So we can go here to block trades and then add combo, and here we have all the strategies. So here, for example, I want to do a call calendar spread, believing that the stock is trying to find a bottom and it's basically recovering. So here the calendar, what will be the calendar is to buy a further term, to buy, for example, 1 month expiry date, a call. Then at the same time we sell the same strike expiring 1 week before. Why? In order to reduce the risk, because when we sell options, when we sell that leg, the second leg, we will receive a credit that will reduce our debit from the buy, and also will receive a theta positive flow that will reduce the theta negative from the from the buy side. For example, here I will go just an example. Here I will buy, for example, this is for the sell, so I will sell, for example, the end of the month, 29th April. Of course, here just an example. I will show you during the next webinar our live trade I will be doing. So I will be studying all the scenarios and so on, and I will be adding here one week. So I'm buying the 6th May and I'm selling the 29th April. So here -1 +1, and the strike, let's say 45,000. Just an example. So calendar, well, basically it should add me the 45,000 calendar call spread. Why here? Because the 45,000 does not trade on the 6th May. So here the 46,000 and the combo price is 0.005. How can I know what will be the price? For example, here one, the side is buy, and I click add. When I click add, I have my strategy here. Well, here the combo will be this price multiplied times the futures price. So it will be 0.005. Let me calculate this up. So 0.0054 times, I saw that it was, I think, well, let's take this one. Here the May 4,400 and some, 40,000, sorry, 453. So this would cost me $218. So you can see that this strategy can be perfect for our volatility trading. $218 in order to create that block trade. Okay, that strategy. If the stock goes up, we can make, basically the calendar can make more than 10 times what we are investing, so basically more than $2,000. But if the stock never goes up, here we will be losing $218. And the idea is not to trade only the calendar calls, but also the calendar puts at the same time, making this double calendar. So either the stock goes up or down, we will be making profits. Our own only risk will be if the Bitcoin stays sideways. Well, you know the Bitcoin not likely to stay sideways. So this strategy, I will be doing it next webinar. I will be taking a live trade with a full explanation. You will see from A to Z how I will be doing. Thank you very much. I wish you have a very nice day and talk to you very soon. Bye bye.